Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Thursday. It's June 30th. I believe it's the last day of the month. I think June only has 30 days. But what a month, man! What a month Thursday has been. July is typically a strong month. It's the beginning of the second part of the year, and usually fund activity is pretty strong. Hedge funds and institutional money tends to come in the first week of July, which is why we have a 4th of July rally about 68% of the time over the last 25 years. I've actually done the back test for that, and I've shown that to some of you guys out there. But we're opening up lower right now, and I'm hoping in today's video, I want to explain to you the issue right now that we're having with the markets and what's really happening to give you a better sign of kind of how to trade and how to prepare yourself for this. Now, the market, we had the GDP yesterday. We had a nasty report yesterday. Everything was lower, and I'll get into the details in a minute. But the market didn't really react till overnight. It seems like the overnight markets, the global markets, didn't like the reaction from the U.S. market, started going down, and then the U.S. market picked up on that on the downside. So the U.S. market is actually reacting. It actually went higher yesterday, not lower. And look, the bond market actually went back within its range, which is really odd because it seems like the U.S. markets were prepared for this data, but the international markets were not, and the U.S. market took the key off of that. So it'll be very interesting if we do go lower or if this will be the bottom. But the fact that the bond market, the fact that the long bond is now moving sideways is very instrumental because it's telling us that the long-term yield is not getting higher. It's staying steady, and if it can stay steady here, while the U.S. economy can work itself back into a positive state, it would be beneficial. So this is us kind of buying time by moving into sideways choppiness instead of going down. It relieves some of the pressure on the stock market, and it tells us that the worst could potentially be behind us. Remember, all of this data that we're getting, it's all lagging, and the market sees everything forward, and it's very efficient. And we've been in this choppy period now, aside from this little gyration when the CPI was 8.6, we actually came right back into it. So this may mean that the market is in fact changing its structure from downside to starting to kind of look to the other end of the end of the road, so to speak, or the beginning of the rainbow, because the market's always discounting everything that's known and looking ahead, and that's what it's doing. Another positive sign is that volatility are not breaking lower. So you're seeing a lot of the indices, and let me just go to StockFetcher. You're seeing a lot of the indices heading lower near the old lows, but the volatility did not even take out the old low. So volatility is actually narrowing out, and this is moving in line. So far, this is moving in line with what I'm seeing in the bond market. And I'm going to tell you guys, the bond market is a lot bigger than the stock market. And the stock market gets its clues from the bond market. So the fact that the bond market is moving sideways is very, very positive. Here's the other big wrinkle I'm seeing right now. And I want to explain this to you so you guys understand this, because I don't see CNBC doing a good job of explaining this to anyone. So if you look cumulatively, you will see that energy, consumer staples, utilities, and healthcare, the four most defensive sectors, are in fact leading the market, which is fine. But when you look on a monthly basis, look at it. You got consumer discretionary, you got technology, you got communication services, and energy's all the way in the last spot. So on a cumulative basis, it looks like the defensive stocks are leading. On a short-term basis, it looked, I mean, especially with consumer discretionary being up here, like we could be reversing. But as we reversed and energies and consumer staples basically dumped, tech stocks started rising, consumer discretionary stocks started rising, and now they're falling down again. So the question is, and I should probably go through this as I go through the charts, but as you can see here, let me show you a good example of what I'm talking about. Where is energy? There we go. Look at that. Energy makes all-time highs or swing highs, breaks down from 93 all the way to 70, right? 30% of its value. And then it starts to rally. It's coming down. Meanwhile, you're still seeing downside in the consumer discretionary sector, but consumer discretionary looks like it's bottoming out. So it looks like we're finding a bottom on some of these sectors like the communication, like the industrial, but it looks like there's a major sector gyration and a rotation, and the market is trying to find its balance. That's why it's very, very difficult to trade this market, because you've got defensive stocks leading for 6 months, then all of a sudden they dump, and all of a sudden non-defensive speculative stocks start leading, right, on a monthly basis, and then it looks like they're coming back down. So it's just really, really difficult to trade this market because of all of these gyrations. And that's partly caused because of the GDP and because there's so much uncertainty and so much unforeseeability in the market right now. Because if the war continues, the odds are that defensive stocks will continue to lead. If economy gets better, if we find out that consumer, that base or raw CPI, consumer price index, peaked out, then tech may start rising. Remember, markets are always forward looking. Anyhow, today we've got jobless claims and personal income, and tomorrow we have ISM manufacturing, which isn't that huge in light of everything we've seen already today. I wouldn't make too much of a big deal about the jobless and personal income. They both have been on the level. They haven't been all that far off. If you look at the jobless claims numbers, let me just give you the expectation. Anything in the low 200,000, anything near the 200-day moving average of 223, even 250, 230, it's okay because it's been low, really, really low. So anything that's a little spike is not going to really change things, especially in light after what we've seen with the GDP report. I mean, it's not that instrumental. Now, here's personal income and outlays. I'm looking for core on a yearly basis. I'm looking for this number, and the core PCE number, I'm looking for this number to be higher. Personal expenditures, I'm hoping that the expenditures and the income stay within the range. As you can see here, the range is all over the place for personal consumption expenditures. But if consumption expenditures stay heavy, that means consumers are still spending. And if they're still spending, there's less chance of a recession. Looking at the global market, and I'll just kind of update what I've just spoke about. Global markets declined Thursday, not that much though, after the U.S. economy contracted, fueling fears of a worldwide downturn. I guess, yeah, global markets did turn. U.S. markets did not, till now. Investors are uneasy about signs that the biggest global economy might be in a recession due to interest rate hikes imposed to cool surging inflation. And on Wednesday, the S&P barely slipped 0.1% after official data showed economy activity contracted 1.6%. in the 3 months ending in March. Remember, that data is lagging. That was the first contraction since the second quarter of 2020 when we were in the depth of the pandemic. May industrial production slumped. This is Japan, 7.2%. Well, they're not doing anything with their interest rates compared with the previous month. That was the sharpest decline since the start of the COVID and reflected disruptions in China due to the antivirus controls. Federal Reserve, Mr. I'm not going to predict the future till I get reelected, Powell said. Speaking at the European Central Bank, he said Wednesday that there's no guarantee inflation can be tamed without hurting the job market. Do you guys remember when it's transitory before he was reelected? Wink, wink. He's not a politician, of course not. The global economy also has been roiled by Russia's invasion of Ukraine, which has been pushing oil, wheat, and other commodity prices, which may cause a food shortage because of all the gyrations we've been seeing with the global food supply chain and all the unforeseeability because of the war. China, monthly purchaser managers index released Thursday by Chinese statistics, which we don't really believe 100% and take with a big grain of salt. They said industry group rose 50.2 in June from 49.6, which means activity is increasing. And folks, China has a lot to do with whether or not the U.S. recovers in one piece. We're going to be looking at the SPY right now. Let me take a look at what I am looking at. Let's see here. What I am looking for is this market to bottom out near the current state and not go lower. And if this can go down to the base and the volatility can stay steady, that would be significant. On the Dow, basically you want to look for a resistance level. And Dow rallied yesterday. We're looking for the Dow to start going higher and not lower in these levels. We're looking for a bottom here, and price levels are pretty low. What I'm looking for is the market to kind of just stay around these levels and start breaking higher as opposed to breaking lower. On the Dow, on the Russell, which actually did go down yesterday. We already are near the low. And again, I think we're going to stay near these levels because markets are really subdued and we've got earnings coming out in a couple of weeks. And I think this quarter of earnings is going to price in most of the gyrations or the fluctuations we have been seeing. Now, sectors. You got to be really careful here. Now, cumulatively, energy, consumer staples, and utilities are still leading. On a monthly basis, you got consumer discretionary, and the rest are like consumer staples and healthcare are still here. My suggestion to you is stick with the consumer staples and healthcare for the time being because they're moving higher or staying here, regardless if we're on a cumulative basis or on a monthly basis. And consumer staples and healthcare should continue rising, whether we're in a inflationary period or not, because people need consumer staples. People need certain things people need. I don't care where inflation is going to go. People are going to wash their hair with shampoo, you know what I'm saying, and drink bottled water. And healthcare isn't going anywhere because most of it is government. And a lot of people who've been waiting to go back to the doctor because of COVID are finally going there right now. So a lot of elective procedures are being done. I know that a lot because we got a lot of older people in this area doing elective procedures right now. My wife tells me all this stuff. So consumer staples and healthcare is what you want to focus on right now. I would personally, if I was looking at these two, which we will do right now, consumer staples looks like it can go up, and healthcare. I prefer right now healthcare. And if I'm going to be looking at healthcare stocks right now, or ETFs, excuse me, I would just look at the XLV. There we go. XLV for you, and the option on XLV, we want to go all the way to September, and you can go to, let's say, you can go to we're 128.50, you can go to the 130. Yeah, it's got great open interest, great liquidity, the spread. Market's not open right now, so it's hard to figure out what the spread is, but I can assure you it's not $1.40. It's probably 20 cents or 30 cents. But the 130 looks pretty good, and the 131 looks pretty good. Either of these two are good. I'm not going to give you a price because I don't know where things will go, but I would be looking to enter these at the end of today or sometimes midday today. Definitely consider these two. They're good options. They expire in September 16th, 79 days to go, and 129 or 130 look pretty good around here. Now, before I let you go, folks, a recent CNBC poll reported 41% of Americans say it's going to take a miracle to be ready for retirement. Remember, there was a horse named Miracle in History of the World Part 1? Don't ask me how I remember stupid trivial stuff like that. So if you're in this huge group of potential investors and already battling soaring costs, then you need to watch this immediately. Legendary trader T-Buzz, Tom Busby himself, and I, we got together this week to share the details of a brand new trading strategy that you have to see for yourself to believe. It's not based on complicated calculations or advanced indicators, and it doesn't require complex trade setups or confusing entries. It's all about finding one stock and one trade at a time. Click on the link below to check out Tom's single stock game plan now. Do it now, don't delay. You'll see me in there as well. It's a great way to educate yourself this summer and stay ahead of the crowd. And tomorrow we're going to talk about weekly recap. We'll reinforce the winners, the losers, and we'll talk about what to expect the following week. Folks, I think we're getting pretty close to the bottom. The bond market and volatility are telling us that. Bond market moving sideways and volatility not making higher highs. I'll see you later. Comments, feedback, love letters, support@marketgeeks.com. Bye, guys. I'll talk to you later. I want to know how you're doing, and I know if I'm trying to keep you out of trouble. Let me know if I'm at least helpful in doing that right now. This is the craziest market in 20 years. Bye, guys. I'll see you later.